Hello, everyone. I'm Paul Washington, Executive Director of the ESG Center here at the Conference Board. The ESG Center focuses on issues of corporate governance, sustainability, and corporate citizenship and philanthropy. I'm delighted to moderate today's session of Sustainability Watch, which focuses on global trends in sustainability reporting. Today, we're going to talk about the key findings and insights from the Conference Board's upcoming report on Sustainability Practices 2019 edition, which will be released in the coming weeks. And I'm really thrilled to be joined by two world-class experts in this field who work with us here at the Conference Board. We've got Thomas Singer. Thomas is a principal researcher in the ESG Center at the Conference Board, and he's joining us from Louisiana. His research focuses on corporate social responsibility and sustainability issues. We also have Anuj Saush, who is leading the sustainability research practice for the Global Sustainability Center here at the Conference Board, and he's joining us from London. So welcome to both of you.
Thank you.
So
Pleasure.
before we begin, I just have a few housekeeping notes to cover. First, we are offering CPE credit for participating in today's live program. To get this credit, you need to enter your full name, email address, and specify CPE in the Request CPE Credit space at the bottom of your screen. Please note that there will be 3 pop-up messages that will occur during the program today to confirm your participation. You need to click OK each time you see one of those pop-up messages, and please stay online for the entire webcast to do so. Second, I want to underscore that we really welcome questions from the audience today. These webcasts are all the better when they're more interactive. You can ask questions at any time by entering them into a chat box at the bottom left of your screen. We'll work the questions into the conversation as best as we can today, and if we can't get to them, we'll follow up after the webcast. Finally, a few other housekeeping notes. You can download the slide deck of today's presentation in the download section at the bottom of your screen. If you want to see us in full screen, you can enlarge the video to full screen view by clicking on the 4 arrows in the upper right hand of your screen today. You can also share this program with your colleagues after the fact, as it'll be viewable on demand in about 48 hours. And finally, we'd ask that you complete the evaluation form at the end of today's session so that we can incorporate your feedback into future broadcasts. And now with that out of the way, let me set the scene a little bit for today's discussion. It seems like the corporate world is really at a pivotal moment right now. Whether you label it as inclusive capitalism, sustainable capitalism, responsible capitalism, fair capitalism, there's really a remarkable groundswell of efforts to reassess and redefine the role of a corporation in today's society. We're hearing it from chief executive officers, the Business Roundtable statement on the purpose of a corporation in August of 2019. We're hearing it from customers and employees. We're hearing it from policymakers and politicians. We're hearing it as well from investors. Larry Fink, the CEO of BlackRock, recently released his annual letter to CEOs, which highlighted climate in particular, but sustainability overall. And then, of course, we're seeing it from a variety of nonprofits and other organizations that have grown up in the last couple of years, and there are more coming every day that are focusing on this topic. Here at the Conference Board, we've been around since 1916, and the topics of helping companies perform better and frankly be better corporate citizens have been on our agenda since 1916. And we focus on it overall at the Conference Board, but we have 2 centers in particular that are really focusing on this topic. One is the ESG Center here in New York, and the other is the Global Sustainability Center focused in Brussels. And we have a whole suite of research and webcasts that are on demand, working groups and other programs that are focusing on this very important topic of the role of a corporation and how corporations can better serve the variety of their stakeholders in society. But one thing that sets apart this moment, I think, from others is that what we're facing now is not brought on by a particular crisis like the collapse of Enron or WorldCom or the global financial crisis. Rather, what's leading, I think, to this moment of reflection and inflection is a continuation and, in fact, an acceleration of some persistent trends, whether they're economic inequality, climate change, the erosion of trust in institutions. So how does that bring us to today? Well, companies are facing both rising expectations and greater skepticism, I think, than maybe at any time in the last several decades. And one piece of this puzzle, a very important piece, is how companies are viewed in the area of sustainability. And they are expected to not only address sustainability substantively, but communicate their views and their programs and their efforts on sustainability to multiple stakeholders. So tracking sustainability disclosures, which is what we're going to talk about today, really provides important insights into where companies are in the sustainability journey. One way to think of it is sustainability is an EKG for ESG. And so we're going to delve into the Conference Board's upcoming report on this topic of global sustainability disclosures. So with that as background, Thomas, so we're about to release this report. Can you tell us a little bit about the report, what it covers, the methodology, and so forth?
Yeah, of course, and thank you for setting the scene there, Paul. I think all of that is extremely important context for what we're about to discuss during today's webcast. Sustainability Practices is the Conference Board's annual report analyzing trends in corporate sustainability reporting. We've been doing this since 2012, releasing an annual study of what kinds of issues are companies reporting on and what's performance like in each of those issues. The data for the report is based on ESG data that's compiled by Bloomberg, and this comes from a number of different sources, primarily sustainability reports, annual reports, and all kinds of other disclosures, including information on websites and information collected through surveys. We now track over 90 environmental and social practices. These include things such as emissions, water consumption information, energy consumption, diversity figures, health and safety data, and more recently we've added information on gender pay gap disclosure. With each edition of the report, you can imagine that we've included additional environmental and social practices as they become more required or more pressured for companies to begin disclosing on those areas. So the number of practices that we covered each year tends to increase, as you can imagine. We've also increased the scope of the report. So our analysis is done both by index, where we look at disclosure by a subset of the S&P Global 1200, and then we also look at disclosure by country. So we examine what the 250 largest companies by revenue in each of the 10 largest economies in 3 regions, North America, Europe, and Asia Pacific, what those companies are disclosing. The breadth of the data and the analysis is overwhelming at times, but it's a tremendous amount of information. So in total, we analyze almost 6,000 companies and their disclosures across the 3 regions that I mentioned. That's a lot of data, right? And most of that data is available for benchmarking purposes through an interactive tool or online dashboard. So you can go in as members of the Conference Board and benchmark the data by sector, by revenue group, and by region. The report itself, of course, doesn't include all of that data, but it does include the highlights, the emerging issues, those trends, those big topics that we should be focusing on. And I think that will be the basis of our conversation today.
Great, that's terrific. And you know, I read a lot of these reports, and this one really stands out, I think, for its global breadth and for the depth of its insights. And we're going to get into that a little bit more. So speaking of the insights, Anu, could you just at a high level talk a little bit about the key takeaways from the reports, the key findings and insights that our members and other viewers would be interested in?
Sure. Thank you, Paul. So as Thomas mentioned, we looked at sustainability reporting practices for around 6,000 companies. And if I was narrating a story, I would draw on the following 3 points. Number one, that we are seeing an increase in the level of sustainability reporting. But actually, what's more interesting to some extent is that it does not translate into changing practices always. So, for example, we know that more companies are talking about climate change issues, but actually whether their emissions are going down or not is a different thing. So we'll explore that a bit later, in detail a bit later. Second, when we analyze the reasons for the increased reporting, we found a strong correlation between regulations and disclosure rate. So whenever there's a new regulation, we see a spike in the level of reporting for that particular area. And lastly, of course, if we try to cast ourselves forward, trying to identify the areas where we feel there might be more reporting. Of course, climate change is one, but we see the issues of gender equity to be a topic where we are likely to see more pressure and likely to see more reporting from companies.
Great, thanks very much. That's interesting. So you've got regulatory pressure driving increased disclosure, but disclosure doesn't necessarily translate into changes of practices. And while one place, is the issues related to gender equity, where I think we see both some changes and then places where disclosure doesn't, in fact, translate to change. So that's a really interesting sort of overall dynamic. And we'll talk about whether we expect that to continue in the future. But meanwhile, let's delve into each of those areas. So Thomas, as Anu mentioned, sustainability disclosure is on the rise, but it doesn't translate into changes in corporate practices or in the impact that corporations are having necessarily. Can you tell us a little bit more about that dynamic? Because it's a little counterintuitive, right? People think that, hey, increased transparency in an area is naturally going to lead to changes in behavior. That's what drives a lot of regulation by the SEC in the United States or by the European Commission in the EU.
That's right, and I think it raises the question, or really reminds us as to what the goal or the objective of disclosure should be at the end of the day. So let's unpack this in a couple of different ways. One, let's focus on the fact that disclosure is increasing. And in fact, if we look at data for the S&P Global 1200, these are some of the largest companies across the world, we see that disclosure across a subset of 20 environmental and social practices. So now I mentioned we track over 90, but if we just focus on 20 that are fairly core to most companies, things like energy consumption or board diversity disclosure or a human rights policy, et cetera, we see that disclosure across these 20 practices has increased by more than 50% compared to 2014. When only about 39% of this index was disclosing on these practices. But now, the latest figures show that companies within the S&P Global 1200 are reporting on 60% of these environmental and social practices. So disclosure is certainly up. But as Anu mentioned, and as you kind of also alluded to, this doesn't always translate in increases or changes in performance. And in particular, when we look at things such as emissions and greenhouse gas emissions, that's one example of this. So over the last few years, yes, we have seen a fairly notable increase in the number of companies reporting their greenhouse gas emissions, from 44% of S&P Global 1200 reporting on emissions back in 2016 to now 61%. So the emissions reporting is up. We're also seeing an notable increase in the disclosure of climate-related business risks. So the number of companies reporting on the risks to their business from climate change. We now see 38% of the S&P Global 1200 reporting those types of risks. But have emissions declined over time? The answer, unfortunately, to that is no. We actually see an increase in median emissions for that same sample compared to 2016. And in fact, we also see an increase when we analyze this by intensity level. So we're not showing a chart here, but both absolute terms and intensity terms, median emissions have increased over time. And we see a similar trend when we examine disclosure and performance on water as well. We see a larger number of companies reporting on water consumption, but we also see median consumption levels increasing over the years, including by intensity. Another area where we are reminded that disclosure does not equal sort of performance, if you wish, is in the area of board diversity. But what you see here is the top 5 countries where companies are most likely to report board diversity figures. So in our sample of companies in Japan, the full sample reported board diversity figures. In the US sample, virtually all companies report board diversity figures, and similarly high levels of reporting in China, in the UK, and in India. But when you examine the medians, so the actual percentage of female directors in those boards, the numbers are very underwhelming. Only 7% of directors among Japanese companies are women. And we see, again, single figures in China, and similarly underwhelming numbers in India, and even in the US and the UK. As we've tracked in a number of years, there's still quite a bit of room for improvement. So what does this tell us? Again, it tells us that a focus on disclosure should be complemented by a focus on, what is the intent at the end of the day? Is it disclosure for disclosure's sake, or is there, or are practices changing to potentially drive changes in performance as well, both in the emissions, but also some social practices, including diversity figures.
That's really interesting. So do you want to talk a little bit about, and this may get a bit into speculation, but what may be driving that divergence in between disclosure and performance? Let's start with the issue of board diversity, and then turn to greenhouse gas emissions. And I'm wondering, whether it's maybe some cultural factors on the former that may be more important than the pressure to disclose. And I'm wondering if on greenhouse gas emissions, it may be because, could it be that as more companies are disclosing, the ones who are coming to the table now actually may not be as far along in reducing their greenhouse gas emissions as the people who disclosed earlier, so that you've got a somewhat different group of companies disclosing that may or may not drive the fact that the median is up. So just curious about each of those, what might be driving the divergence here.
Yeah, part of it is the focus of regulation. So mandates that require disclosure but are not followed up with requirements on performance is certainly one explanation for this. So you may have regulation that requires disclosure of diversity figures, but there's nothing that actually requires the introduction of a certain number of directors, of female directors or minority directors, et cetera. Now we are seeing some examples of regulations that are doing exactly that, and we'll touch on that in minutes. But so that would be one example. The other, I would say, is just a focus on disclosure, a fairly narrow focus over the last decade or so on reporting more. And only recently we're seeing kind of that focus becoming more around reporting more material items for companies, so those that are actually most relevant to their stakeholders, including their investors. So for a while there was a sort of a broad focus on disclosure and transparency without necessarily following up the performance. But now I think we are seeing a trend towards more narrow disclosure on those issues that are most material to companies, and that's why we see initiatives such as SASB and the TCFD reporting frameworks emerging. So that would be one area. I think when we examine on the climate front disclosure versus performance, again, keep in mind we're looking at a fairly large subset of global companies. So if we were to narrow down on perhaps the smaller subset, the S&P 500 instead of the 1200, you may see some improvements in performance. We're taking a fairly global view of a fairly large sample. So again, depending on how you cut the data, you might get different answers. So that would be my take.
So I think that's really interesting. We'll get to regulation in a second. But what you're suggesting is we might see this change as companies, and we're hearing from a lot of our members that they've been doing a lot of broad disclosure in a whole lot of topics, and companies are really striving to sort of focus on, okay, what really matters to me as this company, and as they, and to our stakeholders and to society that we can affect as a company, and as they narrow their disclosure, we might actually see a convergence rather than a divergence of things that they disclose and performance, because they can really focus on these areas really matter to us, and then they can focus on actually achieving goals in those areas, possibly. We'll see. So let's turn to regulation. Anu, we've talked about it a bit. So can you talk about the regulatory developments that we're seeing and how that's affecting disclosure and what it means for the future? And this is a phenomenon that's kind of worldwide right now.
Sure. Now, I guess before I start, I must acknowledge that for a company to disclose, there are a number of drivers. But as I mentioned, I often feel that the pinch point comes in when there is a regulation, and that drives the impact of regulation, and the difference it makes on the reporting is probably the highest. I have taken 4 examples over here. Of course, there are a lot more. But through these examples, we can look at the principles of how a company is thinking and what happens as a result of when a new regulation is introduced. So let's look at the Modern Slavery Act, which I believe when you look at in terms of reporting for human rights, it was quite a watershed moment. Back in 2015, when you look at since the legislation has been launched, you can see there have been 3 kind of the cascade effect has happened in 3 waves. Wave number 1, it put human rights back on companies' agenda. It has always been the case, but somehow it didn't really get that traction. But since the act was introduced, a lot of companies started to talk about it. So that's number 1. Number 2, what we found, of course, a lot of other jurisdictions also followed suit. So there was a country which has introduced the legislation, and then what we find, of course, in subsequent years, the principles of similar legislations were introduced by Australia, Hong Kong, France, and of course, it's being planned in a number of other countries. So that's the kind of the second impact of a new regulation coming in. And of course, when we look at the trends of reporting before and after, we see an increase in the level of reporting. And we went through a similar experience for gender pay gap. So just to set the context, I mean, the principles of equal pay for equal work for men and women has been enshrined in the EU directive since more than 35 years. The first directive was launched, the Equal Pay Directive was launched in 1975. But all it asked was that companies should be provisioned for companies to pay men and women equally. But what the gender pay gap disclosure requirement did was said actually companies need to go beyond and actually start to talk about it, start to report about it. And of course, when we look at the data in terms of what companies have been talking about, there is a clear spike in the disclosure rates since the regulation was introduced. It's a different thing, and again, we go back to what's the purpose of the regulation? Is disclosure enough? And that's all a different debate in terms of is it driving a reduction in the gender pay gap? It is yet to be seen. But of course, the first thing is if it's a requirement to disclose, then it starts getting the attention it is needed to talk about these issues. I have picked out TCFD, which is not a regulation per se, it's a market-driven initiative. But actually what is interesting about TCFD is that a lot of governments, again, have aligned or set out their commitments to align their climate-related disclosure in line with the TCFD recommendations, which is a great thing. I mean, we'll go into more into detail about TCFD, but actually what we see in a way is a convergence. And over the last few years, what we have seen is more number of companies are actually talking about the risks associated with climate change, which is not the case in the past. Last example, of course, which is coming out of EU again, is the directive on non-financial practices, environmental and social practices, which again was introduced in 2018. It's still, you're seeing the trickle effect of this regulation coming into play now and it's likely in the coming years, we are likely to see more and more companies report to conform to the regulations. I guess we often talk about that Europe is the hotbed of sustainability in terms of companies showing leadership or talking about regulations. And I guess I will briefly talk about, which is very recent in a way, it was last month, the EU Green Deal, which sets out the vision for making a commitment for EU and all the member states climate neutral by 2050. And of course, as part of that, so imagine there's a new big commitment which is coming out, and as a follow suit, what is going to happen is we are likely to see a new industrial strategy for the EU. We are likely to see a new circular economy plan, which is proposed for end of Q1 or Q2 this year. What that would mean is, of course, we will have a cascade effect. So there's a big commitment going to climate neutral, and then subsequent policy documents are released. And of course, we're likely to see more legislation in this area. But something else which is also very interesting, which is last year, which I believe is going to increase the interest in disclosure a lot more, is the EU taxonomy, which is part of the EU's Sustainable Financial Action Plan. And what the taxonomy essentially does is it is a list for the investors or the financial community to classify whether their investments are sustainable, are they in transition, or are they enabling? So it's a classification system so that they are very clear about how their investments, what's the bucket their investments fall into. And just to give you a bit of explanation of what these three terms mean. So imagine you have, as an investor, you have 100 units, and you invest 50 units into electric cars. So that's a sustainable investment because it's in line with the climate neutral for 2050. If you invest in cars, we are continuing with the same principle, which are less than 50 grams per CO2 emissions for a kilometer. This will be termed as a transitional investment because it contributes towards the net zero, but it is still not in line with the net zero. And of course, enabling is something like if you're investing in wind turbines, because this enables the transition of the economy to net zero. So of course, there's a requirement for investors, the financial community, to talk about how their portfolios are classified. What that would mean is that they will expect companies to make disclosure on issues so that they are able to meet their requirements, which are set by the EU. So that's we're going to see a trickle effect. So because the investing community is required to disclose certain things, they will ask companies in which they're investing in to be more forthright in disclosures. A wider word of kind of approach, although all of these things are stemming out of EU, non-EU companies which are operating in the EU will also be obliged to respond to these regulations. So I guess if we step back and look at the principle around, there's lots of things happening, and I know that we feel, when we look at the taxonomy, this is likely to be the next exponential kind of increase in the reporting required or expected of companies. So we're likely to see that. And of course, it is not just EU. I mean, when you look at CalPERS and CalSTRS, the largest two pension funds in the US, of course, they have also been required to disclose the impact of climate change on their portfolio. So we are seeing this global trend of an appetite for more disclosure, and we're likely to see that this is going to continue, and regulations are going to drive it.
Right, and so you're seeing regulators enlist investors in this effort, and investors are doing this on their own. Larry Fink, in his recent letter, talked about a significant reallocation of capital that's going to happen toward more sustainable businesses. So I think the investment community, and you also mentioned CalSTRS among others, the investment community is actually already moving in this direction, partly in response to what their own clients are asking for. Let me turn to a couple questions from the audience before we go on. One question relates to whether the conference board has looked at public company disclosure versus private company disclosure in the area of sustainability, which may shed light on whether there's an equal divergence in terms of disclosure and practice in those two areas, and maybe the role that investors play, because public companies will be responding to investor pressure, public companies to consumer and employee pressure, perhaps. So wondering if we've looked at the comparison between public companies and private companies, or you think that if we haven't, if that's an area for us to delve into at some point.
I think that's a fascinating question and would likely yield some really interesting insights. Our analysis of disclosure has been primarily on public companies, fortunately. So I think there is an opportunity to perhaps do some sort of analysis comparing not only the disclosure of public versus private entities, but also on the performance front. What have the changes been for each of those? And as I think the question sort of alluded to, I think there will be some differences due to the nature of where the pressure to disclose and to change practices is coming from for each of those types of entities.
Right. I think it's a great area for us to delve into, and we at the conference board have a number of private companies that are members, so we've got a great population to explore this with. Another question came in about whether companies that may be disclosing a lot of information about areas that are not material to them may actually face, and I'm paraphrasing, may face a little bit of a backlash, because if they're disclosing a lot of areas that aren't material and they're not making progress, could that actually work against them because they're not making progress in those areas, or do they at least get credit for disclosing? So the answer may depend on who's grading the company in those areas, because there are, of course, some rating agencies that say, hey, we want you to disclose in all these areas, sort of regardless of progress. But there are other people who actually care about the progress you're making. So I'm wondering if you all have some thoughts about whether broad disclosure is overall a plus or a minus for companies when they're going beyond what's really material for them, and how that might play out with different constituencies.
Yeah, I'd be happy to tackle part of this question. I know Anu has done some work on rating agencies as well, so I'm sure he's got some thoughts. The first thing I would say is that the trend in disclosure is overwhelmingly towards more material disclosure. So whereas in the past we may have been seeing companies sort of lauded for reporting on a number of different topics and kind of broadening their disclosure, over the last few years or so, the focus has very much been on reporting on those topics that are most material to the organization. And that pressure is really coming from investors to a certain extent, which are fairly dissatisfied with the type of disclosure that is out there, how to make disclosure relevant to their investment decisions. So I do think that the trend is certainly to more material disclosure, and in many cases that means to more focused disclosures, so focusing less on the breadth, but more on kind of the quality and what are those issues that are most likely to be material to an organization. So breadth breadth alone is not sufficient, and I think does sort of risk this notion of greenwashing to a certain extent, and I think that was alluded in the question.
Sure. If I may add, so I mean, Paul mentioned, I mean, there are over about 200 rating agencies, and so you'll have a spectrum of if a same set of data is being looked at different agencies, you will have different ratings. I mean, this has been well talked about in the past. What's most important for companies is, and without naming a few, but if you look at the top 3 or 5 rating agencies, they are actually catching up, and they are focusing on. So looking at if you're looking at a company in the ICT sector or in the manufacturing, they would have filters themselves first, saying what are the most material issues and what is the company doing about it. So as the field of ESG rating agencies is evolving and to a certain extent becoming more mature, we are seeing a transition towards the rating agencies itself evolving their practices to consider only relevant material issues. And we're going to see this trend of focusing towards materiality is going to be more central as we move forward.
Great, thanks. That great question and great responses. Thank you. So now, delving into the third area that you highlighted as a key takeaway from the report, Thomas, it seems that there is this growing focus on disclosure relating to gender equity in a number of areas, from the boardroom to the general employee population. Can you tell us a little bit more about what we're seeing in the trends and disclosure in that cluster of areas?
Yeah, that's certainly true. One of the topics that came up in our analysis in this latest edition of the report was very much kind of these gender equity issues and the pressure to disclose more and to change some practices in this area. And you mentioned the UK gender pay gap reporting regulation, which was introduced in 2017. This is relevant to companies outside of the UK as well. Any company operating in the UK is subject to the gender pay gap reporting requirements. So, U.S. companies and others and their subsidiaries operating in the U.K. are now required to produce these kinds of reports, and we see some examples of them already out there. So that's driving some disclosure in that particular area. We're also seeing, it's not quite the same, but we're also seeing something somewhat along similar lines. Just in September of last year, certain U.S. companies are now also required to report employee salary data by race, gender, and job title to the EEOC. So again, some more movement in that sort of direction. Some of you might be familiar already with the California law that requires companies that are based in California to have a certain number of women on their boards, depending on the size of those boards. And similar laws are now being introduced in other states, including Michigan and New Jersey. And this is one example of disclosure requirements being followed up by sort of performance requirements as well, which I mentioned earlier. In many cases, disclosure is not followed up by performance. So in this case, not only are companies required to disclose, but there's also a requirement for the number of women on boards. And lastly, on this slide, we're also seeing that if we examine what's been going on in India related to board diversity, we've seen that there have been listing and disclosure requirements requiring the appointment of at least one female board member since 2014. But there's been actually very little movement in terms of companies complying with that requirement, except for just earlier last year, updates were introduced to that requirement that really focus on the appointment of at least one female independent director. So again, going back to some of what we were talking about earlier, just because requirements are out there, not only for disclosure, but also for the actual number of women on boards, or even in the case of gender pay gap reporting, compliance in some cases has been fairly lax, especially in India, which is what drove an update to those requirements most recently. Now, something else I'd like to share is the fact that when we look at the topics, the environmental and social topics that were voted on in the 2019 proxy season in the U.S., gender pay gap, the topic of gender pay gap was the most frequently voted topic among all of those environmental and social issues. There were 13 voted proposals on this topic. That is up fairly notably compared to last year. And now, while none of those proposals passed, it did receive about 24% or so of votes in support. That is up from about 14% of support last year. So we do see some trends in the proxy season related to gender pay gap. And if you look at this chart, which lists sort of the top 5 issues in terms of number of voted proposals, you'll see things such as human rights, sexual harassment policies, climate change strategy, and then workforce diversity. 7 voted proposals receiving 38% of support, which I think is fairly notable. What is not shown on this slide is those proposals requesting companies report on board diversity or related to board diversity. That's because there were only 4 proposals, so they didn't quite make the top 5, but 2 of those 4 proposals passed, which I think is fairly notable. So again, the focus on kind of gender equity issues, whether that's board diversity, whether it's gender pay gap, very much in focus, at least among U.S. shareholders. Now, this pressure to report on gender pay gap specifically does seem to be having an effect. When we look at the percentage of companies in the S&P Global 1200 offering data related to gender pay gap, we saw a very notable uptick compared to the previous edition of this report. So, almost a quarter of the index now reports on gender pay gap. And the chart on the right will show you what countries and markets companies are most likely to report this kind of information. And here, very clearly, the regulation effect is significant, with the UK, about 41% of companies in the UK sample are reporting this type of data. So an example of the effect, the very real effect that regulation is having on disclosure.
Great. And then this just illustrates an important area where companies have to make an assessment if, increased regulation is coming down the pike. And so the question is, do companies get ahead of the curve, or do they wait to see the regulation actually come into effect and then respond? And that's a balance that every company has to undertake to figure that out.
Yeah, and I think the notable thing, Paul, is just because we're seeing some of these initiatives taking place elsewhere does not mean that they're not applicable to companies, right? So in the case of the gender pay gap, or even in the EU's non-financial disclosure directive, companies operating in those regions are subject to those regulations. So it's certainly worth noting and keeping attention on.
That's a really important point. There's this extraterritorial kind of impact of these regulations, and we're seeing it not only from Europe, but frankly, I think we're going to increasingly see it from Asia as well, whether it's the Chinese government's social rating system that will apply not only to individuals but also to companies. It's been around for a while, but we're expecting it to take fuller effect this year. So companies need to be aware, no matter where you're headquartered, you need to be aware of changing regulation on a global scale. So stepping back from those specific areas, going to a little more general topics. We got a question here that I think ties in very nicely to the next area that we all wanted to cover as well, which is the change in disclosure. We've talked about two things. It seems to be going more mainstream in that more companies are embracing disclosure in terms of sustainability disclosure. The other thing that's happening is disclosure is going more mainstream in the sense that it's no longer siloed within the corporate social responsibility department, and it's really now something that CEOs are talking about, general counsels, CFOs are talking about, that within a company, disclosure and sustainability has gone more mainstream. So it's more companies are embracing it, and more people within companies are embracing it. And that was the audience question was, what's driving this focus on material disclosure beyond investors? And part of it, I think the answer is, and you can tell me if you agree, some of it's internal company pressure, frankly. If disclosure is now becoming a more core part of what a company is talking about, and you have the CFO and general counsel and CEO focusing on it, they're going to want to focus on what's material. So there are internal corporate dynamics that are also helping to drive this focus on materiality. So so correct me wherever I went wrong there, it does seem as if sustainability disclosure is going mainstream in these two respects, that it's broader and focusing on material. Can you talk a little bit more about how and whether sustainability disclosure is going mainstream?
Sure, I'll just build upon what you said. I guess when you start looking at a longer time frame, there's a bit of an appreciation. I'm saying bit of an appreciation because not everyone thinks this way, but there's a bit of an appreciation of having the term of long-term value, and the appreciation which has come about over the years that both financial and non-financial performance is equally important to be able to assess a company's long-term outlook, how investable it is. or when you start looking at the internal pressures of individuals, or you look at prospective employees. So, and I think that there's been a drive towards a more integrated approach. I'm not talking about integrated reporting, but just a more integrated approach of saying, if the things are material, important to us, let's talk about it. And I think that's part of the thing you just which mentioned of the internal pressures, the internal recognition, and a drive towards that. But taking a step back and looking at whether more companies have embraced sustainability disclosure, I guess the answer to that, from a personal perspective, is yes. Over the years, when you look at the trend, we are seeing the number of reports being published, and also the detail which has been included has been on the up. What this chart shows is, of course, a breakdown of the number of companies disclosing by various revenue groups. Now, you can look at chart in different ways. I guess the 3 points which I read, which I would like to share, my thoughts on this is, number one is actually, when we look at companies with revenues of less than 250 million, or $1 billion, a lack of sustainability reporting should not be construed as a lack of engagement or lack of action on sustainability. We know that, which is the second point, that sustainability reporting has been evolving, and for many companies, or for it's to ensure, to crack it, that this is what is important, this is what is right, this is what we will disclose, is not an easy thing to do. Often smaller companies might not have the resources or the know-how to actually know what's the best framework to use, or what should they be reporting on. So maybe that's part of the reasons, but it should not be construed as that they're not engaging on sustainability. It is not surprising that large companies are doing it. They tend to have more resources, and of course, to some extent, it's important because they also tend to have more impact. Having said that, I guess again, it is well documented that being transparent, talking about your sustainability issues, the impacts, both what you're having, negative or positive, there are a lot of benefits, and companies, irrespective of the size, should consider, if they're not doing it, to embrace sustainability reporting in whatever form is best for them.
Great. Very, very interesting. So we talked about this a little bit before in terms of reporting frameworks, and this is a tricky area for everyone, right? Because on the one hand, reporting frameworks can provide consistency, enabling investors to compare their portfolio companies across industries and even across the entire portfolio. That can also help companies compare themselves and benchmark themselves by using reporting frameworks. But as Larry Fink pointed out in his letter, no reporting framework is perfect, and frankly, what matters to a lot of people is whether a company is telling its own story in an authentic and meaningful manner, focusing on those areas that are truly material. So there's a little bit of a challenge here for everyone in dealing with reporting frameworks. But this report, Thomas, showed some interesting developments in how companies are approaching these different reporting frameworks. I wonder if you want to talk about that.
Yeah, I'd be happy to. And the first thing I'd like to do is just point our audience to a resource we have at the conference board on our website. It's a one-page table essentially comparing a number of different leading sustainability reporting frameworks. In this case, the GRI, CDP, Integrated Reporting, SASB, and TCFD. And what this document does, it's a quick guide to sort of help understand what are each of these reporting frameworks focused on, whether it's environmental issues, social, or governance. Who's the audience for each of these, right? Because the audience for GRI is not the same audience as it is for SASB or TCFD. And also what is required by each of these reporting frameworks in a very sort of concise way. So anyone who's not come across this resource, I encourage you to take a look at it. We won't go into detail here, but just it exists, and it points to differences and similarities between these various frameworks. And as you mentioned, Paul, one of the struggles is the fact that there are multiple reporting frameworks, and companies aren't always sure, which ones are most relevant to them, which ones to pursue, which ones stakeholders are urging them to report based on. So there's some variation, there's significant variation, there's some confusion, and this is an attempt at clarifying what is out there. Now, what we did this year in the latest edition of the report is we actually looked at the number of company financial and non-financial reports that were referencing some of the various sustainability reporting frameworks out there to sort of track their uptick over time, to track how many companies are referencing each of these. And what's confirmed is, again, GRI continues to be the most referenced reporting framework, the most used by companies. But we also saw a couple of other interesting things, namely that the UN SDGs, while not a reporting framework per se, they are being used by guidelines as guidelines by companies to sort of focus their reporting around specific issues. But the SDGs have really gained traction for companies since they were really introduced. And the other notable trend we saw is the growth in references to TCFD. Again, this is indicative of, I think, a need and an urge from investors to get information that is most useful to them. I think one of the biggest frustrations is that they see all kinds of sustainability data being reported by companies, but how do they make it useful for investment decisions? How do they make the data comparable and sort of help guide some of those investment decisions? And that's why TCFD really came about, and we've seen a significant uptick since the recommendations were released in 2017. And in fact, if you look at some of the 10K filings, the SEC 10K filings, we're seeing that TCFD is being mentioned in some of these filings already by a number of companies. In this case, we've included some screenshots of both Adobe and Ecolab and their mentions of TCFD when they talk about the climate risks of the company or some of the reporting around climate risks. So certainly a diversity of reporting frameworks out there. I think this is an evolving area. It has been evolving for a number of years and continues to evolve.
Great. And this has been an area of focus for the conference board and for our members. And yes, that little cheat sheet that you showed earlier comparing the reporting frameworks is incredibly helpful. And I would encourage people to go to the website to check it out. It's at the level that it's helpful to share that with your board of directors, frankly, in some form, so that they understand what the reporting frameworks are out there. So it's a great service. So look, we've got about 5-6 minutes left. So let's turn, if we could, to looking ahead 3 to 5 years. What do you see coming down the pike in a few years in terms of sustainability disclosures, and what do you think companies should be doing now to prepare for that? Thomas, Anu?
Yeah, quickly, I'll talk about assurance. The growth in reporting really requires the data to be comparable, requires it to be of high quality. So I think the trends are out there that assurance of this type of information will continue to become important. We now see that more than half of the S&P Global 1200 are opting to assure some of their sustainability information, but there's a tremendous amount of variation in assurance, not only who's conducting it, but also what gets assured. We conducted a survey in 2019 looking at this practice, and the variation in assurance is pretty formidable. But most typically, companies are assuring things such as emissions and energy consumption and water consumption data. And I think that when we look forward, the growth in reporting really will require assurance to become more and more important for companies.
Great.
I guess from my perspective, what I feel is that the interest is going to increase. What is really important for company is to be able to have a coherent story, not just internally, but for all of its stakeholders. And of course, that is a challenge. Stakeholders expect different things. So to be able to come out with a coherent story which is meaningful to all of its stakeholders, and to do it in a way which is not too taxing, which is relevant, which is in line with companies' values, is very, very important. And I think so. It's not just about data, but it's also about narrative. It's about that long-term thinking. I think that's how somehow needs to be reflected in the reporting.
Thanks. And I would just note that the conference board has a very good report that Thomas, you did on assurance practices, something for companies to look at. And then this topic of companies being able to tell their story, not just provide data, but tell their story authentically and to tell it to multiple stakeholders is an absolute focus for the conference board. And we're going to be convening a working group that'll meet on that topic, and then we'll issue a report on precisely that subject. I would just add one area where I think we may see some increased disclosure over time, which is on companies' economic impact on society. There's increased disclosure on climate, increased disclosure on social issues, but I also think that there's an opportunity for companies to tell their economic impact story more comprehensively. Right now, there's reporting out there on here's our job training program, here's how we reach some underserved populations, but only a handful of companies are really talking about their impact on the economy overall, on economic opportunity. And so I don't know if you think that's an area of opportunity, but it strikes me as one that companies can do a bit more on and would actually benefit them.
Yeah, absolutely spot on. Over the last couple of years or so at the conference board, we've been doing research in this area called total impact valuation. And this is really an emerging approach at communicating a company's societal value. And part of that is figuring out how can you quantify and express in monetary terms and financial terms a company's positive and negative impacts, both on the environmental and social side, but also the economic side. And as you mentioned, Paul, we're seeing some examples, a handful or so of companies that are approaching this type of communication in this kind of way, where not only are they reporting, the kind of negative externalities and sort of their environmental impacts and their social impacts, but they're also communicating the economic story a little bit more. What is the tax contribution like? What are payroll and benefits, et cetera. So we are seeing a number of companies beginning to explore that, and I encourage the audience to take a look at that report, Total Impact Valuation.
Great. Thank you very much, Thomas and Anu. This has been a great discussion. And so thank you. And encourage members of the conference board to go check out the report when it's issued on our website. Those who aren't members will have a brief summary of it up on our website. But consider becoming a member of the conference board if you like, and you'll have access to that and thousands of reports and webcasts and so forth. So I think this has been a great discussion. I would just highlight 2 upcoming webcasts that we're going to have. The next Sustainability Watch is scheduled for February 20th, so mark that on your calendars. The topic of that is digitalization, an enabler of the circular economy. And then on March 19th, we'll discuss a very important topic, sustainability innovation. So keep an eye out for that, February 20th and March 19th, and the discussion of this very important area of sustainability will continue. So with that, please complete the evaluation form if you will, and we'll incorporate it into future webcasts. And thank you, Thomas and Anu again, and thank you all for joining us today for this edition of Sustainability Watch.